Economists expect the Federal Reserve to leave interest rates unchanged at the end of its two-day meeting this week, even though many experts anticipate the central bank is preparing to start cutting rates in the months ahead. In prepared remarks earlier this month, Federal Reserve Chair Jerome Powell said policymakers don't want to ease up too quickly. Powell noted that lowering rates rapidly risks losing the battle against inflation and likely having to raise rates further, while waiting too long poses danger to economic growth. But in the meantime, consumers won't see much relief from sky-high borrowing costs. More from personal finance. Here's when the Fed is likely to start cutting interest rates. Nearly half of young adults have money dysmorphia deflation. Here's where prices fell in 2022 and the first half of 2023. The Fed raised rates 11 times, causing consumer borrowing rates to skyrocket while inflation remained elevated, and putting households under pressure. With the combination of sustained inflation and higher interest rates, many consumers are experiencing higher levels of economic stress compared to 1 year ago, said Silvio Tavares, CEO of credit scoring company VantageScore. The federal funds rate, which is set by the U.S. Central Bank, is the interest rate at which banks borrow and lend to one another overnight. Although that's not the rate consumers pay, the Fed's moves still affect the borrowing and savings rates they see every day. Even once the central bank does cut rates, which some now expect could happen in June, the pace that they trim is going to be much slower than the pace at which they hiked, according to Greg McBride, chief financial analyst at Bankrate. Interest rates took the elevator going up. They are going to take the stairs coming down, he said. Here's a breakdown of where consumer rates stand now and where they may be headed. Since most credit cards have a variable rate, there's a direct connection to the Fed's benchmark. Because of the central bank's rate hike cycle, the average credit card rate rose from 16.34% in March 2022 to nearly 21% today, an all-time high. With most people feeling strained by higher prices, balances are higher and more cardholders are carrying debt from month to month compared to last year. Annual percentage rates will start to come down when the Fed cuts rates, but even then, they will only ease off extremely high levels. With only a few potential quarter-point cuts on deck, APRs would still be around 20% by the end of 2024, McBride said. If the Fed cuts rates twice by a quarter point, your credit card rate will fall by 0.5%, he said. 15- and 30-year mortgage rates are fixed, and tied to Treasury yields and the economy. But anyone shopping for a new home has lost considerable purchasing power, partly because of inflation and the Fed's policy moves. Rates are already significantly lower since hitting 8% in October.